Morning, everyone. Sangeeta Khurana, Professor for Economics. Thank you so much. Welcome to this session. And before I begin, let me start off by inviting my fellow panelists. This panel is on why incorporating ESG into supply chain finance could yield better returns. Let me start off by introducing my fellow panelists. First up, Mike Clark. He's a Vice President, Finance Strategy and Transformation, Coca-Cola Euro-Pacific Partner. Welcome, Mike.
Thank you.
I would now like to welcome Anne Tracy, Chief Sustainability Officer for Colgate-Palmolive. A very warm welcome to you, Anne. The next person I would like to welcome is Ivan. He is the Chief Financial Officer, Vice President Finance, Procurement and Real Estate for Swatch Group. A very warm welcome to you. And last but not the least, very important, Heather. Heather Crawley is Global Head of Supply Chain Finance at JP Morgan Chase. Thank you so much, and a very warm welcome to you and to all other panelists. Let me start off by quickly introducing what this session is all about. To begin with, this is an incredible panel, and I will come to the floor with questions. Time is tight, and I will just take a minute, and we will then head off directly into the panel discussion. Now, by way of introduction, I would like to say that trade finance market is undergoing a radical transformation in terms of ESG, and which is why we decided to come up with this panel, which is highly topical. But the issue is merely addressing ESG objectives and being a so-called a good citizen does not necessarily translate into better business profitability. So companies need to transform their business purpose, their corporate strategy, and their operating model to evolve the business into long-term market opportunities through addressing the social needs. Well, let's get started with the first question. And I would like to start off with Mike, if I may. Mike, if I could ask you, how do you embed sustainability into your key decision-making processes?
Hello, everyone. I think that's a really good question because it's something that I think most organisations are struggling with, in that we have a lot of history of managing the business and managing the performance of the business, but managing different metrics. But managing the ESG metrics specifically is kind of a new thing to do. And I think it comes down to figuring out where it is that those key points of intervention are. When do those key decisions get made? So if you look at sort of reducing your carbon footprint or something like that, or greenhouse gas emissions, it comes down to, what are the CapEx decisions you're making? So if you can get an intervention into your CapEx process that makes sure that you are looking at sustainability metrics in the same way you're looking at payback and other manufacturing metrics. If you look at your budgeting, whether it be your long-range plan, whether it be your forecasts, if you're looking at your mix of your products and how that's affecting, then you've got clarity on those decisions and where those are. And I think the finance departments especially have a huge opportunity here, because often we're the guardians of those processes. We're the guardians of when the CapEx decisions get made, or where the annual planning processes. And so being able to take a broader agenda with those metrics, I think, is really important.
Thank you. Very interesting. Anne, I would like to ask you, how is it that your company embeds ESG into the supply chain? Because you are a massive company, so could you just elaborate on that?
Yeah, so, and I'm the lone man out here because I'm coming from the supply chain side, but I'm really pleased to hear Mike talk that way as a finance person and how we make decisions in the supply chain. It's great to hear. So I want to share a little bit about, we're also a consumer goods manufacturer. So as such, we've been on the ESG journey for quite some time, for over 20 years. So I want to frame kind of what I want to share with you kind of in yesterday, today, and tomorrow. So yes, we've been on this 20 years. We've been measuring, in fact, our greenhouse gas emissions for 20 years, and we've made steep reductions in our own operations, so scope 1 and 2. And fast forward to today, and we develop strategies in 5-year increments. And one of my responsibilities was to develop both what we call our supply chain reimagined strategy for 2025 and our sustainability and social impact strategy for 2025. And now I'm focused on ESG and making sure that we really do keep it not just embedded in the supply chain, but across the whole company in all functions. And as I said, we've been at this for a long time. The supply chain was a leader in embedding ESG, mostly on the environmental and social side. So our current strategy has 3 ambition pillars: driving social impact, helping millions of homes, and preserving our environment. The social impact is about our own employees and the communities where we live and work, and ensuring that we have diversity in our innovation. Helping millions of homes is about our designing more sustainable products and embedding or helping people live more sustainably at home with those products. Now, preserving our environment is really where the supply chain plays a key role. So it's about the circular economy, eliminating plastic waste, zero waste in our facilities, responsible sourcing, conserving water, and very importantly, accelerating action on climate change. And as I am working more and more closely, and I'll talk a little bit more about this in a minute, with our finance teams. That's why I'm glad to hear Mike talk that way, because they play such a key role in helping us now understand the value, not just of the risks, which we're working on, but also the opportunities that brings.
Thank you. Very interesting. And as I understand, you mentioned that the strategy is built along 3 pillars. So let me ask you, Yvonne, what about Swatch Group? How have they gone about designing the ESG standards and adopting them?
So what's interesting is that, as Anne, we've been on this journey since a very long time, at least 30 years, and we also work a lot in this scope 1 and scope 2 items for all of these years. 1 year and a half ago, there was a votation in Switzerland. We are very lucky. The people can help to take decisions also in the way the Swiss country works, and there was a votation about responsible business initiatives, where basically companies could be liable for any problems incurred all over the world, but liable in Switzerland as far as sustainable issues or a social issue would be concerned. Unluckily, this votation was refused by the population by a very small majority, but the Swiss Parliament decided to implement quite demanding reporting standards 1 year ago for quoted companies and banks and insurance and this kind of big companies which have a very big impact on population. And so we started really to make this reporting. We made it the first one this year, like every quoted company in Switzerland. And so, which is, of course, there is not this kind of issue of liability, not yet. We believe it's going to come anyway, but at least this reporting standards which we got, which all companies get all across the board, have a very big impact on us, but also on our suppliers. Switzerland is a country where a middle-sized company represents, roughly speaking, 70% of the value added. So when we work with our suppliers, of course, It's a very big issue we have to address, and we also started to address this issue a long time ago. But it's really positive, and people in Switzerland are, generally speaking, very sensitive about all of this issue about sustainability, definitely.
Yes,
Yeah.
I agree. This is a trend which is fast catching on.
Yeah.
But I really wonder, how has COVID and the ugly head of inflationary pressure that is rising, geopolitical stress, how has that impacted? So let me pose this question to you, Heather. What in your opinion? What is your opinion about these three factors? Have they in any ways or shape impacted on your business and on your thinking?
Well, certainly the demand for ESG-tied supply chain finance solutions has not diminished at all. It still continues to be very strong in the industry. And ESG is the future, and we need to continue to invest in it. I would say that the economic environment that our corporate clients, whether it be in the procurement or the CFO or any member of the C-suite, as they're navigating today's economic environment, from a JP Morgan perspective, we have to be acutely aware of what it takes to really manage an organization in today's financial environment. So we know that our clients are facing inflation, some credit risk, some displacement. And if we think about it, the commodity shock we have today is highly impactful. We haven't seen anything like this probably since the 1970s. So when you think about, for example, I have clients today, especially if they import energy or food, all of our clients, whether they're on the stage today or in the audience, you're acutely aware of the impact of those imports and the cost to your business on an everyday basis. So you couple that with the geopolitical risk that we have, and it really underscores the need to get liquidity to your complete supply chain, from the large suppliers to the small. It's no longer about, 20% of the suppliers or 80% of the finance, and I really need to care for those. Anyone around here knows that it just takes one item on that production line to not be available for that large MNC, and it's done, right? So that underscores the need for a product like supply chain finance that's really all about providing liquidity and financial stability to the suppliers all around. So a product like supply chain finance, it's really going to get payment to those suppliers at a great rate based on the buyer's rating, is fundamental to get through today's environment or the next environment or the next crisis that may come up. So based on the need for, in addition, we know the MNCs are signing up for ESG goals, right? So, or ESG targets. And in order to attain those targets, suppliers need to take action. Whether it means behaving differently, reporting differently, the MNCs have to achieve those goals. So it's a great combination, really, to naturally evolve a supply chain finance program from standard supply chain finance to add ESG, because the buyer needs the supplier needs the buyer, so the supplier can take those actions to meet the corporate's goals and also get that liquidity to them. So based on those two factors, the need to get liquidity to all the suppliers in a buyer's supply chain, as well as the ESG goals that corporates are signing up for, we will continue to see a strong push for SCF ESG solutions going forward. I really do not see that going away, nor the demand decreasing due to the environment we're in today.
Thank you. Very interesting. And it's good to hear that you see that the demand is going to increase. But however, I have a concern, and the concern is around standards. Because we know common standards unite. But sadly, within the context of ESG, we do not have any common standards. I haven't seen any yet, any of these standards evolve, unlike in accounting practices, to give you an example. So my question is, why is it difficult to agree on common standards? And I think can I ask you, Ivan, to...
Why, to develop on this?
Yes, that would be nice.
Yeah. Okay. So in the watch industry, Swiss watch industry, we have a standard in a way, a start of a standard, which is the Swiss-made standard. You heard all of you about it. So basically, we are lucky. It's a standard where we say basically that the value added on the watch has been for a certain percentage, which is 60% of the value added of the watch has been produced in Switzerland. So we started from this. It's a standard which dates back to, if I remember, 1974 or 1975. And based on this, it forces us basically to produce and to verticalize the production in Switzerland. And it's what we did now. Our CEOs have been very visionary in this sense, that so that we have a very much verticalized industrial supply chain in working with many technologies, be it in micro components, electronic components, up to any parts you can find in the watch. In the watches. But it helps really the industry to have this kind of ESG standards in a way. You know, it was as a consequence of this Swiss-made directive to create this kind of standards. And in addition, we have other kind of standards in the industry, which other industry have also, which are the REACH standards, for instance, on chemical components, or ROHS standards, so for instance, as far as lead is concerned, and all of these concerns us a lot. And we believe that these basic standards also help us, even if these are technical standards, to respond to this kind of standards we would lack today in the ESG environment. In addition, in Switzerland, the Swiss government, as I said, the Swiss population is very sensitive about this issue of sustainability. And we have the way, as far as, for instance, energy consumption is concerned. So we made, as many other companies in Switzerland also, some agreements with some organizations in Switzerland, depending on the Swiss governments, to decrease our energy consumptions for gas and oil, etc. It's a plan on 10 years when we get credits, tax credits on this energy decrease consumption. So, yeah, I think, unluckily, there are no standards, as you said, similar to the finance standards which we can find right now. But something already exists which bring us on the right way to be able to respond to these ESG standards. Yes.
Thank you. Very interesting. So I think let's go back to the finance person here. Mike, you lead on financial strategy and transformation. So my question is, would you say consistent approach or rules across countries are important in the current economic climate? Well, I go back again to the point, because inflation is biting each one of us. Do you think, what is your perspective as the financial strategy expert here?
I wouldn't say I'm an expert. I'd say Van is as well qualified on finance as I am. I think if you look at the inflationary environment that we find ourselves in, it's both a blessing and a curse in terms of, sustainability. On the one hand, high oil prices make the payback on any environmental investment to reduce power usage a lot better. So the payback on putting solar panels in, the payback on reducing your power usage is just better now than it was 12 or 24 months ago. So on that perspective, actually it helps the ESG agenda. On the flip side, inflationary pressures mean that you need to pass pricing on. That's a challenge for many businesses, many industries, and that means that potentially there's less money about and less money to invest in inverted commas, discretionary projects, and ESG often comes into those. So I think there's a sort of pluses and minuses in the current environment as to being able to move forward. Certainly, I think, having simple metrics that everybody understands and are easy to measure has got to be a way forward at the moment. There's a lot of different certifications you can get, a lot of different indices you can be in, and often the metrics are quite different. Undoubtedly that takes cost and it takes effort, and somewhere along the way that's effort that could be put into actually doing things that reduce greenhouse gas emissions or reduce water usage.
Interesting. And if I may ask you, what will it take to achieve common standards for the integration of ESG factors into the investment decision-making process?
Yeah, so I'm glad you came back to that. And it was interesting listening to Yvonne and highlighting, because it's a Swiss-based company, the Swiss standards, and part of the challenges that we face across the ESG community is different taxonomies and frameworks all over the world. We're a global company like Coca-Cola. And let's focus on climate. At least science-based targets is the one North Star we have that does kind of level the playing field. But beyond that, it is challenging because the expectations, and you may have heard, we're a U.S.-based company, so we turn to U.S.-based concerns that the SEC, which is what we have to adhere to financially, has now a proposal which will no doubt become reality to disclose climate-related impacts on your company. And so if you want to focus on climate, what they're going to be asking for is that companies assess and monetize both the risks and opportunities, much like if you've heard of TCFD, the Task Force for Climate-Related Financial Disclosures. So, but that may not be exactly what is going to come out of the EU Green Deal, or even the UK for that matter. Mm-hmm. So that's the challenge with the lack of standards. But there are bigger boards out there, commissioned by the ISFR and ISSB that are working together. They recognize the challenge and they're trying to bring together some commonality across this space. But particularly in the case of Colgate, coming back to home, this is a long-term problem. Inflation, we all know, and I think earlier panels talked about volatility is here to stay. We get that. But the climate risk is a long-term issue. So we have to keep our eye on the long term, whether it's incentives or how we look at our financial practices. So again, going back to the yesterday, today, and tomorrow, yesterday, we've been investing. We have a policy in place for the past 10 years to invest at least 5% of our capital into projects that improve the planet, like solar power, water reduction, energy reduction.
So that's more like an incentive you provide, right?
Right. And then, yes. And then what we do know, though, is because we have a net zero carbon target for 2040, there's technology that doesn't exist yet.
Exactly.
So we're actually working with Coca-Cola and Unilever and AB InBev on a program called 100 Plus Accelerator that is infusing and incubating startups that tackle issues and come up with technology that doesn't exist today. Carbon cap, it's across all areas. It's circular economy, biodiversity, carbon capture. So
technology is the buzzword.
We have to invest in the future as well.
Yeah.
And that's a positive thing.
Yes.
To reduce the risk.
Yes, very interesting, because this is, so climate change is an issue that's, as we all know, is becoming increasingly important, very topical, and especially the technologies that are being invested in to address climate change problems is really at the forefront. Last week we were at Chogum and in Rwanda, and there was a full session devoted to clean technology and what could countries do to actually reach the zero mark, the zero mark. Let me move on to Anne. Thank you so much. Let me ask Anne, what do you...
Heather.
Right. No, it's Heather.
Yes.
What challenges do you see within the context of supply chain finance from the perspective of JP Morgan? I mean, we've discussed about climate change, other aspects, inflation, volatility. I'm sure these have an impact. These are factored in, and these are important challenges within the context of JP Morgan as well, supply chain.
Correct. I would say, one of the challenges we have in supply chain finance is actually similar to one of the benefits we talked about, right? Is you can incent suppliers to change their behavior to meet an ESG goal, right? So you can have financial incentives to incent them to change their behavior, whether it be their actions, their reporting, et cetera. But on that same front, it can also be a bit of a con in that you then have to prove and track that. And it's not always easy to do so. And whenever you have any level of vagueness, the audience, whether it be investors, regulators, consumers, may get a little bit cynical in terms of whenever you tie a financial incentives, you're putting that structure together, and you need to ensure that you're showing that there's ESG behavior, positive ESG behavior associated with that financial benefit. Nobody wants to be accused of greenwashing. So from a JP Morgan perspective, when we sit down in front of clients and we want to put this together, we really want to future-proof those programs. I think we've talked about ESG is in a very volatile time. It's maturing. We want to ensure the programs we put in place today for our corporate clients will still be future-proofed for the future. So one thing that we do talk to clients about is putting together, for one, the structure needs to be very structured. It needs to be transparent. It needs to be accountable and rigorous. And I also liked your point, Mike. It has to be simple. You have to be able to see exactly what you're being asked to do. You can prove. It's got to be evidence. It's got to be auditable. And then the financial benefit associated with it. One of the things that I like to encourage my corporate clients to think about when they're putting some sort of structure to overcome this challenge of any sort of greenwashing or not being able to see that full transparency in the model is really to include some sort of ESG scorecard by a third party, right? Then you have an unbiased view. That data comes in, it's reported, and then it can be used to tie to a financial product. One associated program that I'll highlight that actually used that model was in the press a couple years ago was Bridgestone. They really wanted to tie their suppliers to environmental performance as well as a scorecard and scorecarding that. So when they rolled out their supply chain finance ESG program, they involved EcoVadis along with JP Morgan. So the suppliers were incented, one, through improving their environmental performance, but secondly, for having a scorecard with EcoVadis. So between the two, it was transparent, it was clear, we could tie it to the financial targets and evidence that. The fascinating part of that to me was the feedback from the suppliers once we rolled out that program, because the suppliers then had that scorecard. So their biggest incentive from a financial perspective was to be scorecarded, and then they received additional financial incentives as their ESG rating improved. But really, those suppliers were excited about being scorecarded because then you can use that data subsequent within your organization, maybe not just with Bridgestone, but others. So that is a challenge that we have in our industry, is really, one, making sure we future-proof these programs so that they're resilient over time. And the other challenge that Ann talked about is really within trade finance, there's not a lot of ESG standards today, right? We have LMA loans out there from a loan perspective. We have, within Europe, we do know the taxonomy is coming for environmentally valuable initiatives. We don't have that in trade finance yet, and that is a challenge. There's a lot of smart people working on that within the ICC, so I am confident we will evolve to there, but it's not going to be in the short term. So during that period of time, until we have those consistent standards, we as industry leaders, as organizations, as regulators really need to do those simple, transparent programs that are going to be future-proofed.
Thank you. Interesting. And if I may ask, how do you think organizations can be steered towards the required transformative journey? Any thoughts on that?
Yeah, and when I spoke in the beginning about our sustainability and social impact strategy, what I get really excited about this new 2025 strategy is that it's really embedded in our business growth strat plan. So taking that strategy and building it into your business strategic plan is core. And the governance, is really important too. So this comes all the way from our board down to our CEO, down to our senior level C-suite that really is standing behind this program and making sure we're committed to the long term. And really starting to think, and to put it in financial context, about some new financial processes, some new ways to think about it. I'm working more closely than ever with our finance team, so it's helping to break down silos. And, just thinking about how do we value sustainability, both intangibly and tangibly, and how do we, even take into consideration some of the cost avoidances that are very important. So typically in our financial policies, we never make decisions based on avoidance. We always make it based on hard savings, right? That's not familiar. But I'm proud of the fact that our supply chain, and we measure this every year since we've been starting to reduce greenhouse gas emissions, has avoided over $700 million of energy costs during the time frame that we've measured it.
Very impressive.
So that's important,
Yeah,
right?
yeah,
Absolutely.
Looking at the finance.
yeah. Absolutely, why not? Right.
So we're thinking new ways of measuring value of sustainability.
Yeah. There are quite a few questions that have come that people have put up here. Thank you so much to those of you who have sent these questions. Let me start asking these questions to pose these questions to our panelists. Interestingly enough, the first question literally says Coca-Cola, Colgate-Palmolive, Swatch. So 3 of you are there on the spotlight. You have made huge steps with ESG. What government legislation would you like to see introduced to help other businesses catch up? Can I request Ivan to just...
What other legislations?
What government legislation would you like to see introduced to help other businesses catch up?
Yeah, I mean, the one which was on votation in Switzerland, exactly this one, I think it was very good to have companies liable. We start to see now in the US, there was this big news lately of companies starting to be liable because of greenwashing accusations. And I think that the fact that we start to have this liability of companies, I think it would be a very good step forward.
Exactly.
Definitely. Yes.
Actually, this point stuck in my mind, which is why I requested you for this question to answer this.
Yeah.
Any thoughts or comments from others? No. Okay.
Yeah. I think, that's a big question because it's a big world out there. Different governments need to focus on different things. But from a private sector standpoint, I think a company has to look at what's, let's say, material to us, what's important to us. And one of our biggest issues that we're tackling, that we're investing a lot of time, money, resources in, is eliminating plastic waste, because all our products take plastic, right? So, and I know Coca-Cola is equally focused in that space. So I think, Colgate doesn't traditionally engage in lobby with governments, but an important development that's underway right now is there's a UN talks underway to develop a plastic treaty globally that will hold governments actually liable for adhering to the standards.
Are you saying it's creating some kind of an ecosystem?
Well, yeah, definitely in this space, ecosystems with everybody working together is important. Even private sector to private sector, pre-competitive collaboration is key.
Yeah, I'd agree. I think, one of the things we came out a few years ago in favour of deposit return schemes, because it's all well and good your products being recyclable. It doesn't necessarily mean they are recycled.
Right. Exactly.
So, and generally, without some incentive, you improve, but you it's the law of diminishing returns. You get to a certain point and it's quite difficult to get above. Deposit return schemes really can increase that to sort of 90, 95, and higher percentage. And well-run schemes, sort of industry-wide schemes, are the best way to do that. But equally, they need to be, in partnership with government, and one that works for the whole. If it works for the whole infrastructure, then it will work and it will produce the right results. So.
Exactly. There's a very interesting question that has caught my eye. It says, how are you measuring returns on ESG investments? Has it increased the market share of consumers? Didn't quite get the second part, but the first part I would definitely like.
You answer that one.
So how are you measuring returns on ESG investments?
Yeah, I think I think there's a point here that you have to be doing this stuff. It's a kind of in the future you won't be able to operate as a sort of multinational corporation without doing this. To what extent investors take it into account, I think depends on which country you're listed in. It depends on the makeup of your shareholders. It depends on, the long term or short term. I'm guessing that the majority of hedge fund investors are not. This is not high up on their agenda. So I think who knows whether it delivers returns from an investor perspective in terms of raising your share price, but certainly, doing more with less is generally a good business principle.
Yeah, absolutely agree. It's actually a diverse set of indicators that enable us to make those decisions. I have another interesting question on digital technologies and how they can help promote ESG across supply chain through data sharing and environmental reporting. So my question is, can blockchain-based finance solutions capture ESG? Heather, would you like to?
Sure. I mean, where I thought you were going with the technology initially is digitizing is the key to really getting to your smaller suppliers, right? Mm-hmm. And really getting them on board to all of these programs. So absolutely, I do think anything digital encompasses more suppliers, helps them get on board to the programs, absolutely. And blockchain can really be used for absolutely anything you want to tie to. So absolutely, blockchain can absolutely be pulled into the ESG arena to pull together, whether it be the reporting, the sharing of data, et cetera. So blockchain does it. I think the more and more we can go digital to reach out to those smaller suppliers. And then also to Anne's question earlier about challenges and incentives within the ESG world, and to what Mike said, I just want to comment on that as well, is that all the corporates are going to continue to get pressures on ESG. And it's going to come from a lot of areas. It's going to come from the government, like you talked about, and the regulators. That's coming in strong. It started in Europe, but if you can watch the U.S. return to the Paris Accord, you've got China now setting standards. That's globally consistent. Anyone who's got consumers at the end of their supply chain, and Mike for sure, they're going to apply pressure from an ESG perspective. And then you do have the investors, which I definitely hear your words, some are more interested than the others, but they've certainly been focused on the E to date in terms of their investment. So I think all of those pressures are going to continue to put the corporates on a hot spot. And you're lucky, probably if you're in a corporate, that you're only impacted by one of those three factors. I think most people from a corporate perspective are likely impacted by about two of them.
So interesting. It's a set of factors that actually feed into the decision-making process.
Absolutely.
Let me pose the last and final question. And how is it you can turn, we've been discussing challenges, right? How is it we will turn challenges into opportunities for businesses? That's the last question. We have just 20 seconds. Mike.
There's a big question. I think there are huge opportunities here, and I think, firstly, it's the right thing to do. So, and I think corporations and the business world can be really proud of what it's doing in taking a lead in this area, and I think we should not lose sight of that. And I think if you recruit staff, if you talk to customers, if you talk to consumers, in all of those areas, there's huge advantages. In an inflationary world, if you can do things with less, as I say, doing the maximum you possibly can with finite resources has always been at the core of what business is about. And I think the ESG challenge we face is a theme on that. that we're...
This is a great way to actually end the panel by saying, yes, there's hope, there's something positive to look forward to. Thank you so much to all of you for such an interesting discussion. And let us also thank the audience, excellent questions, and the organizers. Thank you so much.
Thank you.
I will-